Well, hi guys, welcome to this Moneycontrol live stream. I am Nandita Khemka. Well, the focus is clearly on the banking space given the fact that there's been a clear dichotomy in the Indian banking universe. On the one hand, PSU banks have seen a stellar up move, and on the other, private sector names have underperformed and significantly underperformed. Well, this underperformance, will this reverse, and what's the view on the entire banking pack now? Well, for that and more, we are now joined by Sumeet Kariwala, who is the India Banks Analyst at Morgan Stanley, and he joins us on the sidelines of the Morgan Stanley India Investment Forum 2024. Great to have you on the show, Sumeet. First of all, let me begin by asking you, what's your overarching view on the entire banking pack post the fourth quarter earnings? Because asset quality seems to have normalized, and some lenders have seen their asset quality, in fact, at multi-quarter highs, right? So what are your thoughts? How would you view the entire banking space post the fourth quarter earnings season?
Yeah, thanks Nandita for having me on the show. So I think the banking sector is in still early stages of a strong upcycle. You will see some normalization of credit cost and margins, but I think over the next 3 to 4 years, the earnings, consensus earnings will get surprised positively. I think the NPL cycle is still quite young. There's not been significant lending that has happened down the quality curve in the retail and SME segment. On the corporate segment, you're still to lend. We're still to see a private corporate capex cycle. So overall, I think the NPL cycle will remain benign and credit costs will remain below normalized levels. Margins have been very strong. Margins, in my view, have peaked over last 3-4 quarters. There will be a gradual moderation that we see over the next 3-4 quarters, and you will see a slightly accelerated one if there's a rate cut cycle, which we are not assuming right now. Loan growth will remain strong. Retail and SME is holding up well. At some point of time, private corporate capex spends will translate into bank credit growth over the next 2-3 years. So I think from a 2-3 year perspective, this 15-16% number will sustain. Obviously, what we need to watch is two things. One is on deposits, where I think so a meaningful part of the challenge is cyclical. As inflation moves lower, as the government starts to spend, you will see deposit growth pick up over the next few years. If you look at last 2 years, deposit growth has accelerated from 11% to 13%, and I think so that has been despite a tight liquidity environment, because real deposit rates have improved, and I think so they'll continue to improve. Deposit growth hopefully coming back should mean that we are able to see a very strong loan growth cycle with benign asset quality, and earnings continue to surprise positively.
Right. You mentioned that private capex hasn't really picked up, and cost of funds are on the higher side as well, right? But despite that, would you be constructive on the private bank space now? And do you think they're actually poised to take the lead from PSU banks?
Yeah, no, this is a good question. A lot of people have asked us on private versus PSU banks. And generally what we've seen is that as we come out of a slowdown, and we've seen that in the 2003 to 2007 cycle as well, the state-owned banks got more impacted because of the corporate NPL cycle then and now. And if you think about when we were coming out of the cycle, and if you look at the earnings expectations for some of these banks, they were very low. When you look at valuations, they were trading at historical lows and so on. And when you think about the upside that these banks could have provided with respect to earnings and valuations, it was massive. And which is why a lot of money has moved into these stocks, and private banks have underperformed. And this is what happens with quality banks in the first stage of a re-rating cycle. If you look at the valuation gap now between private and SOEs, they've come off, and they are at very attractive levels. Over the next 3 years, I don't expect SOE banks to materially disappoint on earnings. They will do well on earnings. They have some room to re-rate as well. But what I've seen is that over the next 2-3 years, what the important factor will be revenue growth, where our assessment is that private banks as a basket can surprise more than the state-owned banks. And this coupled with the starting point of valuations, we think the returns that you could see at private banks could be far better.
But do you think PSU banks still have more catch-up to do in terms of valuations compared to private sector peers?
So if I look at historical valuations, and depending on the state-owned bank that we're talking about, there could be room to catch up because the macro cycle is still quite strong. Okay, so I'm not saying that you will see state-owned banks start to derate. There's no macro concern which is going to weigh on overall bank earnings. So they will continue to do well. The call that we are trying to take, Nandita, is that who can outperform more, who can re-rate more, and that is where our call on private banks over state-owned banks.
All right. In terms of cost of funds, when do you expect that to peak out? Do you think the deposit repricing is almost done now, or do you think there will be some more pressure as the analysts have also been pointed out that the RBI is or need not be in a hurry to cut rates? That's something that's been pointed out by the governor himself, in the recent RBI policy outcome as well, right? That they will be sticking to the pitch when it comes to local triggers rather than global triggers. So even though, first of all, do you expect rate cuts to begin anytime this year itself? And secondly, has the deposit repricing been done, or do you think there's more to come?
Yeah. So our house economist doesn't expect any rate cut in calendar year 2024 or 25. So we're not assuming any rate cuts in the near term. On deposit costs, there are two reasons why deposit cost is moving up. One is the term deposit rates have continued to reprice higher, and that is still happening. You've seen some banks raising deposit rates over the last 2-3 months, and I think that is still to flow through, and which means that you will see deposit rates continue to inch up, and I think so this will happen at least over the next 2-3 quarters. The other thing which is happening is that the share of CASA deposits, the low-cost deposits, that continues to move lower. And in a high interest rate environment, CASA growth will take time to catch up to overall deposit growth. And that is another pressure point. So I think so, will deposit cost peak anytime soon? I would not be in that camp. The only point which I'll make is that the pace of increase in deposit rates will be slower than what you saw in fiscal 24. But there will be a continued increase in deposit rates at least over the next 2-3 quarters.
A couple more questions really. What's your take on the entire NBFC space, given the recent spate of crackdown that we've seen by the RBI? But data also suggests that unsecured lending has come down. RBI, of course, increased the risk weight of unsecured personal loans to 125% from 100%, right? Now, data shows that in these loans, these loans have fallen from high 20s in November to 17% in April. After all the recent action, do you think RBI now may ease up a bit on the NBFC space, and anything that you are liking within the NBFC pack?
Yeah, so I'm not the point person to talk on NBFCs, but I'll answer some part of your questions. On unsecured loans, there has been a meaningful moderation in the growth run rate. Some of that is conscious by the management because they're trying to focus more on underlying credit risk. Some of that is partly to do with the base, because if you look at fiscal 22 and 23, as we came out of COVID, there was a sharp increase because the base was very low. So I think so the unsecured loan growth is normalizing. And this is happening across the system, be it banks, NBFCs, fintechs, and so on, which I think so is a good move. And RBI did mention that they have been tracking this, and things are moving broadly in line with their direction. So I'm not really worried about unsecured asset quality at the system level. There could be some players which might get impacted. But at the system level, I think the trends are okay. And with respect to income growth, job creation, job losses in the formal sector, which is where the unsecured lending happens, some of these leading indicators are working very fine. So my understanding of the RBI move is that they're trying to be proactive, which is a very good sign. And I don't think we are sitting on any potential unsecured NPL cycle at the system level over the next 12 to 18 months.
All right, last question really. You've already pointed out that private banks may have a greater surprise element. So within the private banking lot, would you advise sticking to the large cap names, or would you say your portfolio should be a mix of both large cap and mid cap private banks?
Yeah, we like private banks across the space. But yes, we have an inkling for large private banks versus smaller private banks.
All right.
Sorry, I can't take stock specific questions, so I'll have to leave it on.
Sure. No worries. With that, Sumeet, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. Look forward to connecting with you sometime later again.
Thanks a lot, Nandita.
Thank you. Well, with that, we've come to the end of this, Moneycontrol live stream. But you guys stay tuned, because lots more coming up later in the day, and you can't afford to miss the 11 a.m. interview that's coming up with Upasana Chachra of Morgan Stanley, and of course, subsequently, we'll also be getting you our regular closing bell show at 3:30 p.m. Don't forget to log in for that as well.